Last week, we backtested a 7% rate of withdrawal over the last 10 and 20 years, and it actually held up quite well. But one of the questions I received was, hey, Kevin, why not a 100% stock allocation? Because at the end of the day, the S&P 500 has actually returned 10.5% over the last century. So why not 10.5% rate of return and then only withdraw 7% per year? Initially, I thought the question was a little bit crazy because I'm like, who would ever go into retirement with all stocks? But then I got to realizing, you know what? I'm actually seeing more and more retirees be more aggressive with their portfolio allocation. Maybe it's recency bias, maybe it's risk tolerance, could be a variety of factors, but I thought, you know what? This actually might be interesting to backtest. So today what we're going to do is we're going to look at the last 20 years using 100% stock allocation, all S&P 500, and see how that panned out. And then I ran two other scenarios over the last 10 years and then another special 10-year period that we're going to get into at the very end. For those of you who are new, my name is Kevin Lau. I'm the host of the Planning for Retirement podcast, and I'm also the owner and lead financial planner at Imagine Financial Security. We help individuals over 50 that are looking to fire their boss, maximize retirement income, minimize their lifetime tax bill, and worry less about money. If that describes you, make sure to subscribe to our channel. Make sure to follow our podcast. We'd love to continue on this journey in helping you plan for and execute a successful retirement. So we've been diving a lot into rates of withdrawal over the last few weeks, and I did a podcast episode a couple of weeks ago with this idea that should the 4% rule actually be the 7% rule? So if you haven't listened to that podcast, make sure to go check that one out. I believe it's 92. And essentially, Bill Bengen, who's the father of the 4% rule, he just came out with a new book. I believe it's called Richer Retirement. I have not read the book. I don't think I plan to read it at the end of the day. There are other books that that are at the higher priority list, if that makes any sense. But essentially, he refreshed some of his assumptions with the 4% rule and is now saying it's the 4.7% rule. But I pointed out in that podcast episode that the danger of using the 4% rule as the be-all, end-all is that you might underspend in retirement. You might underspend during your go-go years. Because at the end of the day, the 4% rule, and now the 4.7% rule, assumes the worst-case scenario. A retiree who retired in October of 1968, their portfolio only lasted 33 years. And that was part of the criteria of the 4% rule, is that Bill Bengen wanted to make sure every single retiree at least had their portfolio last 30 years, if not longer. So with that retiree retiring in October of 1968, let's say they were 60, their portfolio lasted still until 93. But then most of the retirees actually experienced a much higher rate of return. In fact, it was 7% was the average. And that's why I said, kind of jokingly, should the 4% rule actually be the 7% rule? But I'm not really joking because there are other downsides of the 4% rule. Mainly, it doesn't take into consideration other income sources like Social Security or their pension income. It doesn't take into consideration the spending phases in retirement, the go-go years, the slow-go years, and the no-go years, and so on. So make sure to check out that podcast episode if you haven't already. And I don't know about you, but the clients that I serve, they would much rather enjoy and maximize their retirement, especially while they're young and healthy, as opposed to planning for some kind of worst case scenario that may or may not play out. And then all of a sudden they're leaving a big pile of money for their heirs that may not even need it in the first place. Or maybe they don't even have adult children that they want to leave their funds to. So this is why I wanted to stress test the 7% rule. So the last Whiteboard Fireside Chat, I stress tested, hey, what if you started with a 7% rate of withdrawal, which has been the historical average with that 4% rule criteria. And we found that, you know what, over the last 10 and 20 years, the portfolio actually held up quite nicely. Again, and then that comment came in that said, hey, Kevin, what about all stocks? And initially, I wasn't really loving that idea. I was like, hey, what person would actually go into retirement with all stocks in their portfolio? But then I realized, you know what, the S&P 500, 10.5% rate of return over the last century, and certainly over the last 20 years has done quite well. So I thought this would actually be an interesting exercise to kind of look at this, because on one hand, you have this average rate of return, and then on the other hand, you have this concern of potentially sequence of return risk. This is essentially the period of time in that early phase of retirement where if you go through a downturn, if you go through a bear market, that could significantly impact the longevity of your portfolio. So that's why I wanted to backtest with this S&P 500 all stock portfolio. So without further ado, why don't we jump into the whiteboard and look at these three scenarios. Okay, just to set the stage with the parameters here, we're going to be starting 20 years ago. So, or close to 20 years ago. We've got January 1, 2006. And we're going to go through 2025, which right now We haven't experienced the full year of 2025, but we're through August. We're more than half the way through the year. Okay, so August 31, 2025. And we're going to start with a $1 million portfolio. And we're going to start with a rate of withdrawal of 70,000, which is essentially 7%. And then we're going to adjust that for inflation. This is one of the keys here, is that once the 7% rule kicks in, okay, or the 4% rule, whatever percentage you're starting your retirement with, that is for the year one rate of withdrawal. After year one, throw out the percentage, because ultimately what you're going to do is you're going to simply adjust that number for inflation each and every year. So if inflation after the first year was 2%, you would inflate that number by 2%, and so on and so forth. The rate of withdrawal is going to adjust based on what your portfolio does. So if your portfolio shoots up in value, your rate of withdrawal may have started at 7%, but now it may only be 6% or 6.5%. On the flip side, the portfolio dropped in value, then your rate of withdrawal may actually be 8% or 8.5%. So it's one of those things that just keep in mind that the rate of withdrawal is going to probably change each and every year depending on the market conditions. But the most important thing is, what is that starting rate of withdrawal? Again, with the 4% rule parameters in place. Okay, that's what I want to point out. And we're going to rebalance annually. We're going to reinvest dividends. So let's see what happened here. First, I want to point out that we are looking at 100% stocks. So in this case, I'm using the SPY ticker, which is essentially an S&P 500 ETF, exchange traded fund that tracks the S&P 500 index. So pretty straightforward, but we're going all in on this allocation. We don't have any other stocks in the portfolio. We don't have any other bonds in the portfolio. So we're kind of extreme here. Risk tolerance is there. We're kind of going on the mindset of, you know what, historically, the S&P 500 has done 10.5%. You know, that should be able to sustain a 7.5% rate of withdrawal. So let's look at the trailing returns on this one. All right. So if we look at the last 20 years, okay, since that January 1 of 2006 through August of 2025, you can look at the rate of return was actually 10.76% on an annual basis, which is funny because then if you compare that to the historical average of the S&P 500, it was 10.5%. So averages tend to play out over time, but in the short term, they tend to deviate from the averages, okay? And if you look over the last 3 years, the S&P 500 has done 19.43% because we're coming off the heels of 2022, high inflation, 9.1% inflation of June in 2022, so much higher than the last 2 to 3 decades. And as a result, stock prices were down in bear market territory, bonds were in bear market territory, and so was cash. I call it the triple bear market of 2022. But since then, pretty solid returns in the S&P 500, positive 19%, despite of the tariff concerns at the beginning of this year, after Liberation Day in April of this year. So I say that because year to year, intra-year, the S&P 500, I don't know if it's ever actually returned a 10.5% rate of return for the year. It's oftentimes positive 25, positive 4, minus 30, positive 40. It goes up and down on an annual basis because of stock market volatility. But over the course of the long term, things tend to play out very, very close to the historical average. And for folks that are accumulating and saving for retirement, that's not a bad thing, because when the markets dip, you're buying in, you're contributing to your 401k, contributing to your Roth account, you're buying shares at discounted prices. For retiree, not so good, because you're not in the accumulation phase, you're in the decumulation phase. And if stocks are down, you may be forced to sell at the wrong time. So just kind of setting the stage for some of the things we're going to be looking at with that sequence of return risk. But over the last 20 years, so far, checking out pretty good. If I'm looking at the math, 10.76%, and my average, my starting rate of withdrawal was 7%, we should be good to go. We should actually have a larger portfolio balance at the end than we started with. But let's kind of see. Let's dive into the numbers. There's a lot of data on this page, but what I want you to do is kind of just ignore the month-to-month rate of return numbers just for now, and let's focus in on cash flow. Again, we started with 70,000, and we're going to adjust that for inflation every single year, and that continues on. Let's look at the balance of the portfolio, and then let's look at the total rate of return on an annual basis. And so as you can see, the first couple of years, we're feeling pretty good. Positive 15.8%, positive 5%, okay? Checking out so far, 20%, essentially total return, average return probably about, a little over 8% a year. And so that makes sense because we started with $1 million and our balance has actually gone up after 2 years. Feeling pretty good after that. You're like, hey, this may be working. I might sustain a 7% rate of withdrawal for the long haul. But we all know what happened in 2008 with the financial crisis. Okay. We went through the worst recession that we've been through in our lifetime. I don't think anyone watching this video went through the Great Depression. Probably not. If you are alive, you're probably not on YouTube. But your parents maybe lived through the Great Depression, okay? Or your grandparents lived through the Great Depression. So you may know what the Depression was and the impact of the Depression. It was awful for the economy, for the stock market. But in our lifetime, 2008 was the worst market we've ever lived through. And I remember I was a finance major at University of South Carolina, go Gamecocks. I remember January 2008, one of my finance professors, he was sounding the alarms. He didn't want to scare us because he knew, hey, these are graduating seniors. They want to be, I want to make sure they're optimistic about the future. But, with bankers, these finance professors, they're very pessimistic by nature. So I remember he was kind of cautiously sounding the alarms in January of 2008. So I kind of remember listening to him and be like, oh, is this a bad time to graduate with a finance degree? I remember a lot of my classmates were just going into grad school because the economy was awful in 2008, especially as a finance major. But nonetheless, I, started my first year, Northwestern Mutual, started as a financial advisor, and it was a chaotic time as an advisor because you had people that were planning to retire. You had people that were saving for retirement, maybe putting their kids through college, and all of a sudden their portfolio dropped by 36% in a single year. And actually, intra-year, the market was down closer to 50%, so it kind of rallied a little bit towards the end. But intra-year, 50% drop. The year end was 36%. Imagine if you were retired and, whether you're 100% in stocks or 70% in stocks or 60% in stocks, imagine the fear you're going through, the uncertainty you're going through. And, if you did manage to stay the course, which is very difficult to do. I remember talking to folks who were retiring around 2008. It was a very scary time. I mean, you think about a company like Lehman Brothers going belly up. I mean, it's just like, what is going on? AIG being bailed out by the feds. I mean, it was the craziest time in the financial sector, and everything was sort of, all of the stock market, every stock price was kind of anchored on this idea that we're going through the subprime mortgage crisis. These mortgages were terrible mortgages to begin with. And real estate prices are crashing. This is the largest asset for most people, most of America. And as a result, stock prices, people are losing their jobs left and right. Stock prices are crashing. Very scary time to be retired. Now, if you were still working, most of you probably were still working at that point in time, it probably impacted you a little bit. But someone who's retired in the decumulation phase, very difficult to stay the course. And look what the portfolio did. We were at over $1 million the year before. We ended that year 3 at $599,000. So you started with $1 million. 2 years in, you're feeling pretty good. But after 3 years, your portfolio is now $400,000 less than what you started with. That's a little scary. But let's say you did manage to stay the course, okay? Continued a little bit of volatility in 2009. March of 2009 was the bottom. Okay, March of 2009 was the bottom. I remember that very clearly, like it was yesterday, because I remember Ted Shanahan, okay, one of our veteran advisors at my firm. He sat us all down. We were all trainees, new advisors, and he said, guys, this is a very important time to advise your clients. But for you personally, I don't know if today's the bottom, but we're either at the bottom or we're very close to it. So take all of your money that's sitting in cash, which for me wasn't very much money, but I had a little bit of money. Put it in the market, invest in stocks. So I did that. That was my first Roth IRA contribution. I remember it probably wasn't exactly on March 9th, but it was probably like March 11th or March 12th. My first Roth IRA contribution. And I can't really backtrack to see like how much that's grown since then. But that was his messaging, was like, hey, if you're still saving, you're still accumulating, put money into the market. And that should be your mindset. If you have multiple years until retirement, that should be your mindset too. You're kind of rooting for prices to go down. But as a retiree, not a great situation to be in. Okay, but let's say you stayed the course, you were rewarded at the end of 2009, portfolio rallied, positive 26%, positive 15% the next year, positive 2 the following year, 2011. I think that was the year that who was the first one to downgrade U.S. debt. I think it might have been, was it Fitch? I think they were the first one to downgrade the U.S. government from AAA to AA. Now all three of the major rating agencies have us at the second highest rating, which is still good, but not what it once was pre-financial crisis. But then the following year, plus 16%, and then plus 32, and then plus 13. So that's, let's see, 1, 2, 3, 4, 5, 6 years. In those 6 years, 5 of them you were double-digit returns, and several of them were above 20%. So if you stayed the course, your portfolio rallied quite nicely. Okay, now at the end of 2014, you're sitting on $812,000. You're like, okay, we're back. We're feeling pretty good. Okay, 2015 was a little bit of a muted year. That wasn't the best year in the markets. And the markets kind of, but it rallied in 2016 again, 2017, 2018, we had a little bit of a blip in the radar. That was Trump's first presidency. And in the fourth quarter, this was part of this was kind of part one of the U.S.-China trade war. And there was a lot of uncertainty with our trading partner, the Chinese. At the end of the day, they're the second largest economy. So there was some uncertainty there. And the markets ended up dropping. We were looking really positive for 2018, but then the markets almost dropped 16% in the final quarter. So it ended the year -4. So that was another blip in the radar during that 20-year period. And then, of course, 2022, triple bear market. Okay. Triple bear market -18%. But what doesn't really show up on this one, is 2020. Okay. If I were to tell you, hey guys and gals, we're going to go through a global pandemic. The global economies are going to shut down. No one's going to be going into work. No one's going anywhere. We're wearing masks. They're forcing vaccines on us. Okay. They're going to shut down your business. They're not going to allow you to go eat at a restaurant. If I were to tell you all these things, and then I were to tell you, hey, listen, at the end of the year, the stock market returned 18.37%, you would have looked at me like I had two heads. And I would have done the same thing, because nobody would have believed you. And, there were some things that happened in 2020. A lot of things that happened in 2020. Some of which I partly agree with, some of which I disagree strongly with. But what happened in 2020 was record stimulus was passed. And we pumped money into the economy in 2020 and in 2021 to the amount of $4 trillion the U.S. did. And do I believe this helped our economy stay afloat in 2020 and 2021? Absolutely. This is why the stock market returned positive returns in 2020 and then in 2021, positive 28%. No one would have predicted that type of return 2 years into the pandemic. But do I believe it led to high inflation? Absolutely. And in 2022, we had 9.1% inflation. I believe it was June of 2022. 9.1% year over year. And stocks were falling. Bonds, -15% that year. And then cash was essentially a negative yield after inflation. So that's why we call it the triple bear market of 2022. So it doesn't show up here, but in the first quarter in 2020, the markets were down pretty significantly. Okay, to the amount of a little over 20%. Okay, so far in that first quarter. And I remember people retiring at the beginning of 2020. I remember several of them. But one of the conversations, I remember it was complete fear that we were going to go into another depression. And his parents had lived through the Great Depression. So who was I to say, no, you know what, Bill? You're wrong. We're not going to go through depression. This is a very smart guy, by the way. He wanted to bail out of the market. He wanted to take his IRA, move to cash. And it was a tough thing. But listen, as an advisor, I need to coach people on the long term. And I told him, Bill, listen, I understand what you want to do. It might make you feel good in the short term. And it might actually work out well for you in the short term. But long term, you need to decide then when to get back in the markets. And we had multiple calls over the course of several weeks. He decided to stay the course. That decision saved him probably $700,000. Because the markets rallied substantially in 2020. No one would have predicted that. I remember the bottom of the market at this time was March 23rd, 2020. That was the bottom of the market in 2020. And I remember that because it's my wife's birthday. And I remember, very similar to the March 9 of 2009, I remember saying to my wife, hey, listen, hey, babe, I don't have a crystal ball. I don't know if this is the bottom, but we're either at the bottom or we're very close to it. this could be a good buying opportunity. So I moved some of the cash that we had on the sidelines. I put it into stocks. That really helped out. That helped me start my business, truthfully. One of many factors. But I was an accumulator. I was still in the accumulation phase. Again, I'm rooting for the downturns. Someone who's retired, not feeling very good. And so I point that out because even though it doesn't show up on the stat sheet as a minus return in 2020, I'm telling you, it was a scary time. Okay. So if we kind of look at all these overall, we had 2008, big downturn. We had a little bit of a blip in the radar here in 2018. We had a significant drop during 2020, significant drop during 2022 with the triple bear. But overall, if we look at this thing, when all is said and done, you fast forward 20 years, we're sitting on $994,000 with a 7% starting rate of withdrawal, adjusted for inflation each and every year. Assuming you stayed the course and stayed in the S&P 500, this plan actually worked out pretty decently. But then I wanted to look at two other time periods. Two other 10-year time periods. The first one I wanted to say, hey, what about the last 10 years? It's been a strong market. Let's take out 2008. Because how many times are we going to go through 2008? Hopefully never again. Hopefully never again. But we could go through a market where the S&P 500 is down 30 or 40% or even 50% worse. Okay? Could happen. I don't know what that's going to be. It's not going to be, the exact same as the dot-com bubble bursting or the Great Recession, the financial crisis, or the pandemic or the trade war or whatever it might be. It's going to be something else. I can promise you there's going to be something that is going to rattle investors, result in a sell-off, and we're in a bear market. I don't know what that exact thing is going to be, but it's going to happen. But let's maybe take out the 2008. Let's say, that's a kind of worst case scenario. Let's only go back 10 years. So then what I wanted to do is look at a 10-year period. January 1, 2016, $1 million, 70,000, inflation adjusted. Let's see what it does. So here we already know we had the downturn in 2018, we had the downturn in 2020 that ended in a positive, and then we had the downturn in 2022. Look at this one. We started with $1 million. We started with 7% rate of withdrawal. Portfolio balance at the end of 10 years, $2,259,000. So we've more than doubled our portfolio after 10 years, starting with a 7% rate of withdrawal. Okay, very tempting. And this is why I think a lot of folks are having a little bit of a recency bias. This is why I believe the folks that are reaching out to us over the last, let's call it 2 years, their mindset is be a little more aggressive, stay a little bit more aggressive in equities. And listen, I'm a fan of not getting too conservative too early in retirement. I've talked about this on the podcast several times and on the Whiteboard Fireside Chat several times. I think this idea of own your age in bonds, I think that's a little bit, that's dated. Okay, that shouldn't be the rule of thumb today. Because if you're 60, that means you need to have 60% of your portfolio in bonds. That probably didn't pan out very well for you over the last 20 years. Bonds have been doing terribly. Okay, but I think this is the recency bias of, hey, bonds have been doing terribly. Stocks, particularly the S&P 500, have been doing phenomenal. Why don't I go more aggressive into equities? And so this is why I'm doing this next one, is because, hey, let's look at a different 10-year horizon. Let's look at the lost decade. And for those of you that are not familiar with the lost decade, it was the period of time from 2000 through 2009 where the market was actually a negative rate of return. The market being the S&P 500 was a negative rate of return. There had never been a 10-year period where that was the case. The S&P 500 has always been, or had always been, a positive rate of return in every single possible rolling 10-year period until the lost decade, 2000 to 2009. Why is that? Well, we had the dot-com bubble bursting in the early 2000s, and then we ended it with the Great Recession in 2008. Not a great time. However, someone who retired at the beginning of 2020, or I'm sorry, the beginning of 2000, they just experienced this bull run in the 90s that was phenomenal. The dot-com bubble was brewing, okay? People were, investing in, if the company had a dot-com behind its name, people were buying that stock. And valuations were way overinflated. And that resulted in the dot-com bubble bursting in the early 2000s. But you didn't know that. An investor who retired in January 1 of 2000 didn't know that bubble was going to burst. For all they knew, this was going to continue. The tech bubble the tech boom was just getting started. And it was, looking in hindsight, it was. But we had to go through that bubble bursting first. And unfortunately for this investor who started with $1 million and wanted to get that 7% rate of withdrawal that first year, they didn't fare out too well. Let's look at the returns in that first 3 years. Minus 9.7% year one. Minus 11.7% year two. Minus 21.5% year three. Ooh, I don't know about you, but this person probably went back to work, truthfully. They probably went back to work after those first couple of years. They probably realized, you know what, I can't do this. I can't continue to draw down my portfolio. I'm probably going to run out of money. And they were right. If you look at this one, they started with $1 million. After the first 3 years, the portfolio went down all the way down to 441. And just hypothetically speaking, if they did stay the course, they didn't sell out of the market and go all to bonds. Let's say they stayed in the S&P 500. They were rewarded over the next few years with some positive returns, but then they hit 2008 again. And we just talked about 2008, the Great Recession, the worst market we've seen since the Great Depression. And they ran out of money in 2010. Their portfolio went to zero. So that's two different 10-year periods, pretty close to one another, that one resulted in the portfolio more than doubling and the other resulted in the portfolio going to zero after 10 years. This is why I'm emphasizing this idea that when you're in the accumulation phase, average rates of return matter a lot, okay? Sequence of returns it doesn't matter as much for an accumulator. In fact, anytime the market's dipping, you should be in the mindset, if you have disciplined processes in place, you should be of the mindset, you know what, this is a buying opportunity. I don't know about you, I like to find deals. I don't like to overpay for things. And if stocks are overpriced, I'll buy them still, but I don't love it. I'd rather buy when stocks are undervalued. And when the market's down in 2008 or in 2000 to 2002, when the market's down, those are usually opportunities to buy, not sell. When you're retired, it's not about the average rate of return. Okay, it's about the sequence of those returns. The problem is nobody has a crystal ball. Nobody knows what kind of market they're going to retire into. If you retire into a great market, things probably work out okay for you. But if you retire into a bad time, it's the complete opposite. You might have a high probability of outliving your assets. Okay, but again, we have the benefit of hindsight. This is what we're doing with the back testing, and I point this out because I think a lot of folks have the recency bias that the market's just going to continue to do what it's done over the last 10 to 20 years. Okay. But I'd love to hear from you. If you've recently retired, let's say over the last 3 to 4 years, and you went through 2022, what strategies did you put in place? Or if you're retiring now or plan to retire soon, what strategies will you put in place to protect against the dreaded sequence of return risk? I'd love to hear from you in the comment section. But don't worry. If you don't know the answer to these things, I have a podcast coming out next Tuesday, and I'm going to address this. I'm going to dedicate the podcast solely to talking about strategies and ways that you can help protect against sequence of return risk. So make sure to subscribe to the channel. A little shameless plug there. Make sure to follow the podcast, and that'll be coming out next Tuesday. And finally, if you're like, hey, you know what, Kevin, this is a lot. I'd love to get a second set of eyes on what I'm doing for retirement. I would love for you to tell me, hey, am I on track? How can I maximize my spending but not run the risk of outliving my money? How do I minimize my lifetime tax bill? How do I worry less about this whole retirement thing? This is what we do day in and day out. This is our day to day. And we'd love to help you. So if you want to learn more about working with our firm, go to our website at www.imaginefinancialsecurity.com, or you can start with the retirement readiness questionnaire that's linked in the show notes or the description. We'd love to hear from you, learn a little bit more about what you're looking to accomplish, what's important to you, what you're worried about, and see how we can be a fit to help you plan for and execute a successful retirement. Thanks everybody for tuning in. Until next week, this is Kevin Lau signing off.